Let's get more with Sally Auld, interest rate strategist at JP Morgan, and Stephen Nash from FIIG Securities. Well, welcome to you both. Sally, let's start with you if we can. And these investor appetite momentum plays on TIPS. They are the Treasury Inflation Protected Securities. And a telling read, I guess, on inflation expectations.
Yeah, good morning, Carson. It was quite interesting. This was the first auction. It was actually a reopening of an existing TIP security, but nonetheless, the first auction where TIP securities actually went at a negative real yield. So they went at a negative yield of around 50 basis points, which is quite remarkable. So that's effectively saying that as an investor, I'm prepared to pay the US government a real yield of 50 basis points rather than the other way around. That's one interpretation of it. The other interpretation of it is that basically there's good demand out there for inflation-protected securities because people are taking the Fed at their word, which is effectively that the Fed is going to do whatever it takes to generate above-trend growth and generate some genuine inflation over the next sort of 3, 5, maybe even 10 years. And the best way to sort of take advantage of that, if that's what you believe is going to happen and you take the Fed at their word, is to actually own securities that will benefit in the event that we do see genuine inflation come through in the US. So I think we're going to start to see a bit of a pickup in demand for these sort of securities.
And by benefit, we know the Fed's inflation target is 2%. Apparently, if they do bring that about, that would see investors receiving roughly a 2% increase in principal for the next 5 years. So you get a total return of 10%.
Yeah, that's right. I mean, it's and you sort of phrase it in those terms, and it's a pretty attractive proposition. So, investors aren't buying these because they've got high real yields, which is one reason why people like Australian inflation-protected securities, they're buying them basically because they're willing to take a bet that the Fed will get what it wants, which is obviously higher inflation over the next 3 to 5 years.
Stephen Nash, bringing you into all of this, aren't we presupposing one big thing here that we could all end up looking very embarrassed over, and that is simply that if the economy does not rebound, inflation won't happen? What if I put to you that excessive US dollar weakness brings down the cost of imports, as we know, if anything. It does the opposite. It puts imports into play in a big way, and those commodity prices keep rising. That's going to be passed on to the consumer eventually with higher prices. That's called stagflation.
Yeah, yes. I imagine that's one possible scenario, but I think right now there's a dual problem: high unemployment, higher than forecast, and higher than desired, and lower than desired inflation. Now, getting the economy out of this hole is something the Fed's really focused on at the moment, and I think the currency is an important issue there. And I think the US is becoming increasingly frustrated with various emerging markets, and I think there may be some action with regard to that at some stage.
The problem, Sally, is that there is next to no growth in the US economy. We know this. We'll get this reminded to us with GDP next week. Now, if you then put interest rates up, don't you go back to the 1970s and see unemployment touching 20%?
I think that's sort of one thing that the Fed is clearly trying to avoid. I mean, those guys have a dual mandate, and it's for, low but sort of not too low inflation and, sort of reasonably low unemployment, and they're sort of striving to do what they can to get there. I think part of the story is the Fed is essentially saying what we want is growth, basically, and if we get growth, then we're going to ultimately get some inflation. If we get growth, we're going to get enough to start bringing down the unemployment rate in the US. So, part of the story really is sort of weakening the dollar, basically saying, we want risky assets to rally. And if we sort of do that, that's going to help the deleveraging process, whether it's still financials, whether it's households. Higher asset prices are one way that you can actually deleverage. And if you deleverage more quickly, then hopefully you can get some more growth. So, I think there are sort of lots of different...
But wages are not keeping step. I'm just putting to you again the proposition. Yes, you can raise inflationary expectations, but if your growth is marginal and then you start ratcheting up those expectations and prices in turn rise, but there's been no accommodation in higher wages, you do create a compounding problem. You get stagflation.
Yeah, I mean, it's sort of interesting in the sense that, what you really want is you want sort of household disposable income to sort of start to go up. And, in aggregate, if you look at sort of hours worked in the US economy and what sort of average hourly earnings are doing and everything, that's actually been moving in the right direction. So, having spoken to a number of clients sort of in the US over the last couple of weeks, it's sort of interesting. One of the themes that kept coming up was, maybe the Fed is sort of doing exactly the wrong thing at the wrong time, in the sense that maybe there's enough of a recovery happening in the US, and if we just give it a little bit more time, it's going to become self-sustaining, and the Fed sort of is pouring fuel on the fire, i.e. more easing at exactly the wrong sort of time, and maybe the risk is that you actually get a much stronger rebound in the US economy than anyone actually envisages. So, I actually think, even though maybe what you're talking about could be a tail risk, and it's certainly one the Fed don't want, I would sort of suggest that if anything, you get the sense that sentiment is maybe starting to swing the other way, and people are actually starting to become a little bit more optimistic on prospects for the US.
Stephen, and Sally's been in the US taking the pulse there on it. The point also that could be made is that, yes, people are working longer hours, but they're not getting paid commensurately with that. They're being required to keep their jobs. Almost, it's this Faustian pact, thou shalt, sit at the desk for another 4 hours, but sorry, there's actually no payback, other than you keep your job and be jolly grateful for it.
Well, I think the current environment is making consumers very conservative. They're not going out and spending. I think that's what the Fed really wants people to do. It wants to engender that idea of confidence, and it's just not there at the moment. So these measures that are going to be enacted towards the start of November, I think are going to be really important, and I think you can expect the Fed to be quite aggressive.
You see,
whether it's enough for the market is another. I think the market's reaction is going to be very important for authorities.
It's hugely important because the US is so dependent on imports in many ways itself. It brings in a lot, and that only gets more expensive with a weak currency. We're rejoicing the opposite. But with a weaker currency, no, more expensive. Commodity prices, I mean, you've got to say the pass-through. We're looking at CPI here tomorrow. The jury's out until we get the number. But, if the pass-through happens, that's clear evidence that you and I are paying for that.
Well, I think there's some evidence of utility inflation, which is more a structural issue. I don't think the RBA is going to be that concerned of that particular theme in the inflation numbers. However, if we do see other areas elevated as well, that could get them excited and could lead to some tightening. But as I said before, I think the market reaction, to the Fed's meeting is something the RBA won't have at that meeting. And I think that's going to be a really important piece of information they won't have. In addition, I think there is this gathering storm with regard to the currency. It's an issue for the US in the sense that they want to ensure that emerging markets share some of the pain that they're experiencing. They've got the unemployment rate is too high. They want some moderation in that, and adjustments in currency may be one way to assist with that.
All right, Sally, a fruitless desire, or is there actually going to be some realisation of that want to bring about equilibrium?
Well, I guess it's all part of a much bigger process, which is not going to be fixed in sort of 3 months or 6 months or maybe even 2 years. It's all about sort of effectively, rebalancing across the global economy, and really what has to happen is standards of living in the West have to decline relative to standards of living in the East, and that's all about rebalancing growth in Asia, particularly China, away from export-driven growth towards consumption-led growth. So, this sort of appreciation of Asian currencies versus the US dollar is a small part of that whole story, but it's still a necessary one. And I guess the Fed are sort of going after it reasonably aggressively at the moment. But ultimately, it's the right thing for the global economy. So, I sort of think that even though there are a number of central banks or monetary authorities that can sort of fight this in the short term, ultimately, probably in the long term, it's going to prove reasonably futile, and that's exactly what we need for the global economy. Over a sort of 10 or 20-year time horizon.
Stephen, Glenn Stevens yesterday was saying, if anything, when it comes to currency adjustments, it's almost sort of missing the 8 ball over it. It's not going to, equilibrium won't spur global growth, to paraphrase.
Yeah, well, I think that the issue for the US isn't about global growth, it's about the distribution of growth. It's about other countries effectively renting out their consumers, and they're getting a little bit tired of that. And, with the advent of QE2, it indicates the US is getting a little bit, the policy options are running out. Currency is one of those options they need to pursue, and that's what they're doing.
But they have manipulated their own currency. They have absolutely no license to preach.
Well, yes. I mean,
it's just it's almost sort of a fallacious,
Well, I think they're just looking for some more market-driven level of currency, and I think that some probably accelerated increase in the Chinese currency is probably the most likely outcome.
All right. A likely outcome on CPI in terms of how our bond market is reacting, Sally, that print tomorrow?
Yeah, it's been interesting. I mean, the bond market sort of took fright at those PPI numbers yesterday that obviously came in stronger than expected. So we have seen yields rise. We've sort of gone through that psychological 5% level in 3-year bonds quite easily, which maybe sort of highlights risk that, you know, yields can continue to track higher from here. But, you know, ultimately, you know, the numbers will be what the numbers will be tomorrow. And I sort of get the sense that there aren't very many people expecting a big upside surprise. If anything, the number will probably come in around expectations. So market reaction to that will be reasonably muted. And then, of course, you know, we have to wait until next Tuesday to find out what the RBA make of it all. But, you know, whether or not sort of short-term fluctuations aside, I still sort of think, you know, on a medium-term view, 5% level in 3-year bonds in Australia looks like a pretty attractive buy level. So, you know, for a strategic investor, you know, my strategy around these sort of levels would be looking to buy the dip.
Stephen?
Yes, look, I'd probably agree that, you know, I think to some extent, I think people in this country don't get that linkage between what's going on in the global scene, particularly with this Chinese debate. Now, if the US can increase the value of the Chinese currency substantially or accelerate that, there will be an implication for Chinese growth and therefore Australian growth. So this is going to happen over the next year or so when the RBA is worried about constraints in the local economy. So if Chinese growth was to moderate, that lifts a lot of the concerns for the RBA, I think.
And it's inevitable that I think Glenn Stevens is also saying, you know, the Asian growth story is not just one-way traffic. It's going to have that sort of the growing pains. It takes a step forward and then maybe 2 back, but it's still growing.
I think the recent Chinese figures indicated that there's a possible difficulty in the sense of domestic consumption. They've got to switch the train from export-led growth to domestic, and that's very difficult. They're trying that at the moment. There'll be more done on that, but I think that's the really important point. It's not really there at the moment.
They can encourage all they like, but without the mechanisms, without the security blanket rolled out, there'll be kind of scanned uptake, arguably, or it won't be consolidated. We do appreciate you coming on, Stephen Nash, and from JP Morgan.